What if I told you that $100 is all you need to unlock the world of investing and set yourself on a path to financial freedom? It's not a myth. It's a strategy anyone can start today. Whether you're a student, a young professional, or someone ready to explore the stock market for the first time, this guide will show you how to transform your first $100 into the foundation of a successful investment portfolio. Let's dive in and make your money work for you. Set your goals. Investing without a clear goal is like driving without a destination. The first step in your $100 investment journey is to understand your why. Why are you investing? Is it to save for a vacation in the next year? Or are you planning for long-term financial freedom or retirement? Maybe you just want to get your feet wet in the stock market and learn. Defining your goals helps in determining your investment strategy and level of risk tolerance. For example, short-term goals might lead you to less volatile assets like ETFs or bonds, while long-term goals may allow for riskier stocks with potentially higher returns. Goals also help keep you motivated when the market fluctuates. Reminding yourself of your why can keep you focused and disciplined, ensuring you stick to your investment plan rather than reacting emotionally to market noise. Choose a beginner-friendly platform. With just $100 to start, finding the right platform is critical. Thankfully, many modern investment apps and brokerage platforms cater to beginners. Look for platforms that offer fractional shares, as they allow you to buy portions of expensive stocks. For instance, instead of needing over $2,000 to buy a share of Amazon, you can invest $10 or $20 and own a fraction. Many platforms like Robinhood, Webull, or Fidelity also have zero account maintenance fees and offer user-friendly interfaces to simplify your experience. These apps often include educational resources to help you learn as you invest. Compare platforms based on fees, features, and ease of use before committing. Most importantly, ensure the platform is trustworthy and regulated. Starting small with $100 doesn't mean you should compromise on security. Your money should always be in safe hands. Learn the basics. The stock market might seem intimidating at first, but you don't need to be a financial expert to get started. Educating yourself on the basics can make a world of difference. Begin by understanding what a stock is. It represents ownership in a company. When you buy a stock, you're purchasing a small part of that company. Next, familiarize yourself with terms like dividends, market capitalization, and price-to-earnings ratio. These will help you analyze companies and make informed decisions. Explore free resources. Many brokerage platforms provide tutorials, blogs, and even beginner-friendly courses. YouTube channels, podcasts, and books like The Little Book of Common Sense Investing can be invaluable. The goal isn't to master everything at once, so you feel confident when making investment choices. Pick your first investment. Now comes the exciting part, choosing where to invest your $100. This step involves research and decision-making. Start with companies you understand or use daily. Do you love your iPhone? Consider Apple. Are you a Starbucks regular? That could be a contender. The idea is to invest in businesses you believe in and understand. If individual stocks feel overwhelming, consider exchange-traded funds, ETFs. And ETFs are bundles of stocks that track an index, like the S&P 500, and offer instant diversification, spreading your investment across multiple companies to reduce risk. Fractional shares make this process even easier, allowing you to invest in high-value companies with just a few dollars. Use tools like Yahoo Finance or Morningstar to check the performance and financial health of your chosen investments before committing. Stay consistent. Consistency is the secret sauce of successful investing. Starting with $100 is fantastic, but to truly see your portfolio grow, you need to commit to adding more over time. Even small regular contributions make a difference thanks to the power of compounding. For instance, investing an additional $20 a month may not seem like much, but over years, those small amounts grow significantly. Automating your contributions can help you stay consistent. Set up a monthly transfer from your bank account to your investment platform. This set-it-and-forget-it approach ensures you're building wealth without even thinking about it. Consistency also applies to learning. Stay curious about market trends, company updates, and investment strategies to refine your skills as an investor. Automate your investments. Life gets busy, and it's easy to forget about investing when other priorities demand your attention. That's where automation comes in. Many platforms offer auto-invest features, allowing you to schedule regular investments into your chosen stocks, ETFs, or mutual funds. This not only saves time, but also ensures discipline. Automation removes the temptation to time the market, a mistake even seasoned investors struggle with. By investing the same amount at regular intervals, you benefit from dollar-cost averaging, which smooths out the highs and lows of the market over time. For example, if a stock's price drops, your scheduled investment buys more shares, maximizing potential returns when prices rise again. Automation makes investing a seamless part of your financial routine, ensuring consistent progress towards your goals. Monitor and learn from your portfolio. Investing is not a set-it-and-forget-it activity entirely. While automation helps maintain consistency, you still need to monitor your portfolio periodically. This doesn't mean obsessing over daily price changes. That's counterproductive. Instead, review your investments every few months to ensure they align with your goals. Use this time to evaluate performance and consider adjustments if needed. For example, if a stock consistently underperforms or no longer fits your strategy, it might be time to sell and reinvest elsewhere. Equally important is learning from your portfolio. Analyze why some investments perform well while others don't. Was it market trends, company decisions, or your initial research? These insights will make you a smarter, more confident investor over time. Diversify your investments. One of the key principles of investing is diversification. Putting all your money into one stock or asset class can be risky, especially with a small initial investment like $100. Diversifying means spreading your investment across different types of assets, industries, or even geographical regions. This strategy reduces the impact of a poor-performing investment on your overall portfolio. With $100, you can achieve diversification through ETFs or mutual funds that bundle various stocks together. For instance, an S&P 500 ETF includes shares from 500 large companies, giving you exposure to multiple sectors like technology, healthcare, and consumer goods. Diversification protects you from market volatility and ensures that your portfolio has a better chance of consistent growth over time. Start building an emergency fund. Before diving deeper into the world of investing, it's wise to ensure you have a financial safety net. Building an emergency fund should be a priority even as you start investing. An emergency fund is a savings buffer that covers 3 to 6 months of living expenses. It's crucial because unexpected expenses like medical bills or car repairs can derail your investment journey if you're forced to withdraw money from your portfolio prematurely. Start by setting aside a small portion of your income each month into a high-yield savings account. Once your emergency fund is established, you can invest more confidently, knowing you have a financial cushion to fall back on in case of unforeseen events. This step not only secures your finances, but also reinforces a disciplined approach to managing money. Reinvest your earnings. As your investments begin to generate returns, reinvesting those earnings can significantly accelerate your portfolio's growth. Whether it's dividends from stocks or interest from ETFs, putting those earnings back into your portfolio creates a compounding effect, essentially earning returns on your returns. Many platforms allow you to automate dividend reinvestments, ensuring that every dollar earned goes back to work immediately. This strategy helps you maximize the growth potential of your investments, even with a small initial amount like $100. Over time, reinvesting can turn modest earnings into substantial wealth, making it one of the most powerful tools for building a successful investment portfolio. Congratulations! By starting with just $100, you've taken the first step toward mastering the stock market and building long-term wealth. Remember, it's not about how much you start with, but about staying consistent, disciplined, and focused on your goals. Every dollar you invest today has the potential to grow exponentially over time. So keep learning, stay curious, and watch your financial confidence soar. Your journey has just begun, and the future is brighter with every smart decision you make.